Picture waking up one day, heading to work, and finding out you're out of a job. And worse, every single cent you saved up after years of grinding, just stolen overnight. No explanation at all. That's exactly what went down with Charles Prestwood. 20 years, just gone in a flash. Over $1.3 million saved up for retirement, wiped out to zero. 20,000 other folks had that exact same Tuesday. Mr. Prestwood played by the rules. So did you. And honestly, that's the scariest part. I'm Ethan Graves, and you're about to decode the financial traps the system was never built to protect you from. How did a company become the 7th largest in America? And how did it use the system's own playbook to rob the folks who trusted it most? We're talking about an accounting trick the SEC actually greenlit back in '92, right at Enron's request. Over 3,500 shell companies set up specifically to sweep losses under the rug. And that 30-day window? That's when executives dumped over $1 billion in stock, while 20,000 employees, regular people like Charles Prestwood, were legally locked out of touching a dime of theirs. So the one question that really haunts this whole case is this. If every single layer of the system, the lawyers, the board, the auditors, the regulators, was doing exactly what it was supposed to do, how the hell did Charles Prestwood lose $1.3 million before lunch? Enron started back in '85. Back then, it was just a natural gas pipeline company. Useful, boring, totally under the radar. Then Jeffrey Skilling showed up. He had a Harvard MBA, a reputation as a visionary, and one idea that was about to flip everything upside down. What if Enron stopped being just an energy company and morphed into an energy trading company instead? Don't just move gas through pipes. Bet on the future price of energy and literally pull a market out of thin air. By the year 2000, it was actually working. The stock was sitting at $90 a share. The company was valued at over $60 billion. Forbes, Fortune, Businessweek, they were all calling it the most innovative company in America. But there was something buried in those reports that nobody was looking at closely enough. In '92, at Skilling's personal request, the SEC greenlit a brand new accounting method for Enron, one that would completely derail the course of trading for the rest of American history. They called it mark-to-market. Sounds complicated, but it's really not. Mark-to-market basically meant the exact second Enron signed a long-term energy deal, they could log the entire estimated value of that contract as pure profit. Just like that. Without waiting for a single cent to actually roll in, even if it took years. Or even if the money never showed up at all. It was already on the books as profit. Picture this. 1993, Houston. Enron's finance guys just inked a 20-year gas contract with a power company in Indiana. Estimated value? A cool $140 million over 2 decades. Under mark-to-market, Enron booked that entire $140 million the very same day the contract was signed. Not when the gas got delivered, not when the check cleared. The exact moment the ink dried. The SEC gave it the thumbs up. The auditors checked it off. The board signed it. And boom, that was the perfect trap. hiding right in plain sight. But here's the catch. Mark-to-market only works if your estimates stay super optimistic. As long as the deals keep rolling in, as long as the stock keeps going up. The second something goes south, the gap between what you claimed you made and what you actually brought in starts to balloon. By 97, Enron had a massive problem. The gap was just too wide. They were reporting profits that straight up didn't exist. And that's when they brought in Andy Fastow. Andy Fastow built a system that, by every legal standard, was technically allowed. He set up more than 3,500 separate companies. They had names, they had addresses, they had bank accounts. But they didn't have a single employee, no real offices, and no actual products or services. They had one job: to eat Enron's losses and keep them off the official books. Didn't the auditors catch this? Of course they did. Arthur Andersen, one of the biggest auditing firms on the planet, reviewed this whole setup every single year. They signed the financials. They handed out clean audits for 16 years straight. 16 years without finding a single red flag. Doesn't that strike you as a little weird? In August 2001, Sharon Watkins, Enron's VP, wrote a memo straight to Kenneth Lay. Her exact words were, Lay got the memo. He called up Enron's lawyers, and they basically told him not to sweat it. But there was another name in Watkins' memo that never made the front pages. Cliff Baxter. Baxter was a former Air Force captain. He had a Columbia MBA and joined Enron in the early 90s. By 2000, he was second in command. Behind closed doors, he was the guy telling Skilling to knock it off. And what you're about to see is exactly what Watkins put in that memo. Baxter ended up quitting in May 2001, 7 months before the whole thing went down. He stuck around as a consultant, quietly telling anyone who'd listen that something was seriously wrong. Then, on January 25, 2002, just 2 weeks before he was supposed to testify before Congress, Cliff Baxter was found dead in his Mercedes, a single gunshot to the head. He left a note in his wife's car. He was 43 years old, leaving behind a wife and 2 kids. What you're about to see is what he wrote in that note. Where there was once great pride, now it's gone. The one executive who actually tried to blow the whistle from the inside was the first one to die. On October 17, 2001, Enron sent out a notice to all its employees, effective immediately, a 30-day administrative lockdown on all 401k accounts. Charles Prestwood had over $1 million in his. Tom Paget had $600,000. Michelle Robichaux was sitting on nearly $1 million herself. They spun it as just a routine administrative update. Totally standard. Nothing to see here. But during those 30 days, while employees were blocked from selling a single share, executives cashed out over $1 billion in stock. Was the lockdown illegal? Nope, obviously not. It was a scheduled change, reviewed by lawyers and approved by the board. 100% by the book. That's the whole point of this story. That was always the point. While the lockdown was in full swing and executives were quietly dumping their shares, everyday people were already paying the ultimate price. Bill Peterson had worked at Enron for years. His wife's name was Cathy. The exact same week Enron filed for bankruptcy, Bill was diagnosed with melanoma. The doctors gave him a 50-50 shot, saying a positive attitude was key to pulling through. He went into cancer surgery that same week, coming out with 3 drainage tubes in his side. Enron had promised to keep paying his disability benefits while he recovered. They put that promise on official Enron letterhead. But on December 2nd, 2001, that letterhead didn't mean squat. Cathy talked about that moment. Her husband on the phone, lying in a hospital bed with 3 tubes in his side, just listening. He goes, I understand. And then he just gave a thumbs down. 9 months later, Bill Peterson passed away. And Bill wasn't the only one. 5,000 laid-off Enron workers got their health insurance totally axed. Some had cancer treatments lined up. Some were waiting on surgeries. Some had kids dealing with chronic illnesses. All of it, literally all of it, just canceled. Nathan Childs' wife, Adina, was 29. 3 days after their coverage got cut, she had a stroke. It wasn't covered. They had to drive 90 miles round trip, 4 days a week, just for therapy. They ended up losing their apartment. The Enron fraud wasn't just numbers on a balance sheet. It wasn't just a spreadsheet error. It hit the operating table. It hit the ambulance. It hit the pharmacy line for meds that nobody could afford anymore. But here's the craziest part of it all. Mark to Market was officially approved by the SEC back in '92, at Enron's own request. That SPE shell structure, reviewed and approved every single quarter by Arthur Andersen for 16 years. The 30-day account lockdown, checked by lawyers and approved by the board. Technically, totally compliant. Canceling Bill Peterson's benefits, signed off by a bankruptcy court. Completely lawful under Chapter 11. Every single layer of the system, the regulators, the auditors, the board, the courts, was doing exactly what it was built to do. So you gotta ask yourself, if the accounting trick was legal, if the auditors gave the green light, if the lawyers cleared the lockdown, and if the courts signed off on cutting benefits, who the hell was this system actually designed to protect? On December 2, 2001, Enron filed for Chapter 11. $63 billion in assets just vanished overnight. At the time, it was the biggest corporate bankruptcy in U.S. history. The stock tanked from $90 to less than $1 in just 14 months. $20,000 people were out of a job. Charles Prestwood's $1.3 million, gone. Tom Paget's $600,000 shrank to $11,000. Bill Peterson's disability check, canceled. Adina Childs' insurance expired 3 days before her stroke. Meanwhile, the credit rating agencies The guys whose literal job is to warn investors if a company is going under, kept Enron at investment grade right up until 4 days before the bankruptcy. Over at Arthur Andersen, Enron's auditors for 16 years, they started shredding documents the second the SEC announced a formal probe. Thousands of pages, entire boxes of archives, physical evidence just destroyed before the feds even walked through the door.
Sure, they got slapped with an obstruction conviction, but the Supreme Court threw it out later on a technicality. Not a single auditor ever went to prison for the collapse. As for the executives, Jeffrey Skilling got 24 years, which got knocked down to 14. He got out in 2019. Ken Lay was convicted in July 2006, but died before sentencing, so his conviction was wiped clean. He died with 0 criminal record. Andy Fastow got a 6-year sentence and was out in less than 5. Nowadays, he gets paid to give speeches on corporate ethics. 20,000 people ruined, and 0 executives locked up for the actual fraud, besides Skilling and Fastow. And the money? Nobody ever gave it back. You're probably thinking, wait, what about the money? Nobody gave it back. Then the lawsuits hit. $7.2 billion in shareholder settlements, the biggest payout in U.S. securities history at the time. The headlines called it justice, but the math told a totally different story. Investors lost roughly $47 billion. For the folks who stuck it out in the class action suit, the total recovery was maybe 20 cents on the dollar. The lawyers, they pocketed $688 million in fees. As for the employees, they had their own separate settlement, $85 million total, split across more than 20,000 workers. Deborah Parada spent 5 years at Enron. She lost $40 grand in her 401k.
She actually testified before the Senate that she was told to expect about 6 cents on the dollar, after the lawyers took their cut, of course. Severance pay was a whole other battle. Workers were owed an average of 37 grand each. What did they actually get at first? A check for $4,500. After taxes and insurance, that came out to about 3 grand. And here's the kicker that proves you can't just call this an accident. 7 years after the collapse, in 2008, $11 million had to be returned to the Employee Settlement Fund. Why? A software glitch. Over 20,000 workers had been paid the wrong amount. Some got too much, some got too little, messing up a total of $22 million.
7 years after Enron went belly up, they were still botching the math. Always against the victims. Here's the part you won't catch in most documentaries. Mark-to-market is still a thing. Tweaked versions of those SPE shell companies are still being used by massive corporations right now. And the auditors checking their math? They're usually getting paid by the exact same companies they're supposed to be policing. Sure, the rules that let Enron happen got updated. Congress passed Sarbanes-Oxley in 2002. They set up new watchdogs, made auditor conflicts a bit tougher, and demanded more transparency for off-the-books entities. But the core problem? It hasn't budged. The system that was supposed to have the backs of those 20,000 employees was built by, funded by, and ultimately answers to the very companies it's supposed to regulate. That didn't change with Enron, and it hasn't changed since. Look, before you take off, I really thought about what to leave you with here. It'd be easy to just show you what happened to those 20,000 folks and move on. That's what most docs do. But that's not what this channel is about. The red flags were all there. Every single one of them. Some were literally sitting right there in the annual reports in plain English, if you just knew what to look for. And that's exactly what I want you to walk away with. When Enron employees were asked what the company actually did, a lot of them couldn't give a straight answer.
Skilling himself once called it a gas and a risk company. Rule of thumb: if you can't explain how a company makes its money in one simple sentence, you need to get an answer before you invest a dime. Mark-to-market was legal, yeah, but it forced Enron to guess their future profits, sometimes decades out, and book that money today. Rule of thumb: anytime a company counts cash it hasn't actually received as current profit, you gotta ask, what happens if those guesses are wrong? Enron's annual reports were full of mentions about affiliated entities. They were complicated, buried in the fine print, and pretty much unexplained. Rule of thumb: whenever a company does heavy business with other companies it also controls, that demands a deep dive, not a free pass. In the months before it all went south, executives dumped over $1 billion in stock. Meanwhile, employees were pushed to hold on to theirs, and a lot of them did, trusting the company line. Rule of thumb: when the guys in charge are cashing out while telling everyone else to hold the line, that's a massive red flag you can't ignore. Arthur Andersen wasn't just auditing Enron. They were also raking in millions in consulting fees from them. Rule of thumb: if an auditor relies on a client for a huge chunk of their paycheck, that's a structural conflict that's almost impossible to ignore. In the months leading up to the crash, 16 out of 17 Wall Street analysts had Enron rated as a buy. 1 had it at neutral. 0 said sell. Rule of thumb: when every single expert agrees on something 100%, it doesn't mean they're right. Sometimes it just means nobody's actually doing the homework. Remember Charles Prestwood, the guy from the start of the video. 20 years of hard work. $1.3 million saved up. He never got that money back. The class action suit tossed him pennies on the dollar. His house wasn't paid off. He was dealing with heart disease. Years later, he told CBS News, "It takes a strong person to stand against the wall, recuperate, and come back. The harsh truth? Most folks don't come back." The 20,000 people who lost their jobs and life savings in December 2001 didn't miss these red flags because they were careless. They missed them because the system designed to spot those flags was built to protect the guys waving them. Bill Peterson didn't die because he was gullible. Adina Childs didn't lose her health coverage because she skipped the fine print. Cliff Baxter didn't end up dead in a Mercedes because he kept his mouth shut. And Charles Prestwood didn't lose $1.3 million because he wasn't paying attention. Now you know exactly what those red flags look like. You know the names of the folks who didn't spot them in time. So use them before somebody has to add your name to the list. If you're still watching, you now know more about how this massive fraud went down than most of the people sitting inside that building. This could absolutely happen to you. So hit subscribe
every single week, we decode another piece of the system that was never built to protect you. If this opened your eyes, smash that like button. It takes 2 seconds and tells the algorithm that stuff people actually need to see. And share this. Because the more people who understand how these traps work, the fewer people will fall into them.